Thank you so much for joining me. Today's session on the disposal of non-current asset really covers content for the FAPS unit at level 3. And I'm hoping at the end of the session I can give you some really useful tools and techniques to help you go away and deal with any future questions or assessment issues that you may have with regard to this topic. At the end of the session, we should be able to competently record the disposal and part exchange of a non-current asset. So we're going to delve into the world of double entry and look at what those transactions look like for those two processes of a business. We will also have a look at how we calculate any profit or loss on the disposal. We'll look at the methodology for that calculation, and we will also close off the respective ledger accounts for the year end and ensure that we're comfortable with how our financial statements would reflect this potential profit or loss on disposal. The two primary financial statements we're concerned with at level 3 are your statement of profit or loss and your statement of financial position. The statement of profit and loss monitors the performance of the business over an accounting period, generally a 12-month period. It looks at the sales the business has made. It takes away the associated costs of those sales, and it also takes away the overheads, the expenses of the business. And that ultimately helps us derive whether as a business we've made a profit or loss for that accounting period. Really useful with a statement of profit or loss to be able to compare prior periods with each other to see if we can establish trends. Hopefully a trend of increasing sales and reducing costs would be ideal. The statement of financial position is often referred to as a snapshot of the business at a particular point in time. It shows the position of a business at a particular date, generally your accounting year end. This financial statement ultimately shows what a business owns, its assets, what a business owes, its liabilities, and how that business has been financed, its capital. And those three terms should be quite familiar to us. Assets less liabilities equals capital. The statement of financial position is indeed an expression of our accounting equation, which is something we should be comfortable with at this point in our studies. I'd like to take a moment now just to stop and reflect on the statement of financial position. We've established that this statement is a snapshot of the business at a particular point in time, and in this example that point in time is the 31st of March 2024, and we can see that by the closing capital date at the bottom of the statement. That means that at the 31st of March 2024, all these balances are very true and very accurate and reflect the position of the business. But on the 1st of April 2024, those balances will move on as new business transactions are processed. So it very much is a snapshot of that business's performance. I've previously said that the SFP is also an expression of the accounting equation. It looks at what the business owns in terms of its assets, and we categorise those into non-current assets and current assets. It looks at what the business owes in terms of its liabilities, and again we split it into current and non-current liabilities. And then we look at how that business has been financed by the capital invested in the business by the owner. And we add to that any potential profit that has been made during the business, that's been reinvested back into the business, and we deduct any drawings made during the period. The SFP is quite a popular statement with students because they can glean quite a lot of confidence that they've processed the majority of these transactions correctly if the net assets and the closing capital figure agree. And you can see in this example they certainly do. They agree on a figure of £98,217. That net asset figure ultimately is calculated by the net book value of my non-current assets. I add on my current assets, I take away my current liabilities, and I take away my non-current liabilities, and in this example that's a bank loan. The net assets of the business is in essence showing the amount by which our total assets exceed our liabilities. And sometimes that's often referred to as net worth, how much that business is valued at. Now we can see that a significant contributing factor into that calculation is indeed the non-current asset at its net book value. And we can see at the top of the SFP, we've got a net book value of our non-current assets at 86,742. So it's key that this section of our SFP is accurate. It's key that we get it right, because if we don't, we could then be in a position where we're under or overstating the net worth of our business. We know that cost column shows the value that the asset has been acquired at, plus all the associated costs of bringing the asset to its current condition and location. We know the middle column, the accumulated depreciation, recognises the year-to-date depreciation on those assets. And the cost less the accumulated depreciation gives me what I refer to as a net book value. Sometimes you may hear that referred to as a carrying amount, but ultimately the net book value is an estimate of what we think that asset is worth. And the focus of this session is going to be trying to maintain the integrity of that section by making sure that when we do dispose of a non-current asset, we do so accurately and we reflect those transactions appropriately in the financial statements of the business. When we dispose of a non-current asset, there are two effects, or there are two processes that we need to account for. The first is to ensure that all the associated accounting entries for that disposed asset are removed from the ledger accounts of that business, which means that we must remove the non-current asset value from the asset account, the original cost of the asset. And we must also remove the associated accumulated depreciation for that disposed asset. Having done that, we will then calculate the profit or loss on disposal, and we must ensure that's accounted for in an appropriate way. Whenever an asset is disposed of, we will create a disposal ledger account, and that ledger account enables us to process the double entry for the disposal. Once we've done the double entry, it will enable us to recognise whether or not we've made a profit or loss on disposal, and reflect that accurately in the financial statements of the business. So now let's look at what happens when we calculate that profit or loss on disposal. And we're accountants, we're aspiring bookkeepers and accountants, so let's keep it simple, let's do the maths. We'll take the cost of the non-current asset, that's the original cost that would have been capitalised at the point of acquisition. We will deduct any accumulated depreciation, the year-to-date depreciation on that asset, and that will give us the net book value. So initially what we're doing is we're looking at those three columns on our SFP, the net book value, what that asset is worth. We will then compare that to the disposal proceeds, and we will compare the net book value, what we think the asset is worth, to the proceeds that have been realised upon sale, and that will help us decipher whether a profit or loss has been realised. If the net book value is higher than the proceeds, that means we've incurred a loss on disposal, because it means that we thought the asset was worth more than we actually got for the sale. If, however, the net book value is lower than the proceeds, then a profit has been realised. And again, in that example, it's because the sale proceeds exceed the net book value, the amount that we thought the asset was worth. So we need to keep that calculation in mind as we go through the forthcoming slides. So let's take that mathematical approach and apply it to an activity. Bradley Enterprises has disposed of a piece of machinery for £4,500. The original item had cost £18,000 and had accumulated depreciation of £12,200. All we have to do, and I make it sound so easy, but all we have to do is calculate the profit or loss on disposal. And to do that, we'll follow the process that we saw on the previous slide. So we will look at the cost of the original item. We will deduct any accumulated depreciation, and that will arrive us at a figure for the net book value. We know the proceeds, so a comparison of the proceeds and the net book value will determine whether a profit or loss has been realised. Guys, I'm going to hand over to you now, and I'm going to ask you to do that calculation for me. So if you can tell me whether it's a profit or loss, and if you feel brave enough, also tell me what you think that figure is. Please don't worry if we're not sure, that's okay, but anyone that feels able and wants to participate, I gladly welcome your comments. So I'm just going to pause for a moment, guys, and let you collect your thoughts, and we'll see how you get on. Perfect. Thank you for that feedback. So let's have a look at that solution. The cost of the non-current asset, we're just going to fill in the template. We're just going to look at the original information. The £18,000 was the cost of the original non-current asset. 12,200 is the accumulated depreciation, the year-to-date depreciation on that asset. And that enables us to calculate a net book value of 5,800, so what we think the asset is worth. The question tells us that proceeds amounted to 4,500. Proceeds were less than the net book value, meaning, as we've quite rightly established, it's a loss on disposal of 1,300. We thought the asset was worth more than it actually was valued at on sale. And that loss on disposal will ultimately be shown on our statement of profit or loss, and it will be showed as an expense to our business. It will increase expenses and therefore will reduce the overall profit for the period. So now let's look at the double entry, the 3 steps that are required to deal with this disposal of a non-current asset. There are 3 steps to concern ourselves with, and the first step is to remove the cost of the asset from the relevant asset account. The second is to remove the associated accumulated depreciation relevant to the disposed asset. And last but not least, our third step is to recognise the proceeds from the sale of that non-current asset. So by doing that, we will be increasing our asset at bank as money is received from that sale. We're going to use these 3 steps throughout the remainder of this PowerPoint because steps provide structure, structure provides confidence, and once we have confidence, it will help us secure marks. We know the 3 steps we need to process: the asset removal, the accumulated depreciation removal, and then recording the proceeds. So let's now see how that works in terms of the double entry. Step 1, we will debit the disposal account and we will credit a non-current asset account. Step 2, we will remove the accumulated depreciation by debiting the accumulated depreciation account and crediting disposal. And step 3, we will record the proceeds by debiting the bank, money's coming into our business, and we will credit the disposal account. When we dispose of a non-current asset, we create a disposal account, and that helps facilitate the actual transaction itself. It also will help us calculate that profit or loss on disposal. If you're like me, when you get into an assessment, regardless of how thorough and methodical your revision has been, nerves sometimes get the better of us and we tend to forget things. But if we can remember the logic of the 3 steps, the removal of the asset, the removal of the accumulated depreciation and recording those proceeds, then as you can see in all of those 3 steps displayed on your screen, half the double entry, either the debit or the credit, goes through the disposal account. And consequently, that should help provide you with some form of technique as you approach these type of questions. So 3 steps, that's all we need to do. Of course, every learner is different and learning steps may not necessarily work for all of you, and that's okay. So what you could visualise is how the disposal account would look. Step 1 is to remove the value of the non-current asset. And we do that by crediting the asset account and debiting disposal. Step 2 is to remove the accumulated depreciation. And we do that by debiting the accumulated depreciation account and crediting disposal. And the final step is to record those proceeds. We debit the bank and we credit the disposal account. And just like any other ledger account at the end of the period, this account must be closed off. The disposal account is recognised on the statement of profit or loss, so the balancing figure will be transferred through to the statement of profit or loss, and the figure that goes forward will either be a profit or a loss. So when we come to balance off, when we come to transfer the figure to the relevant statement, if the balancing figure is a credit, it will indicate that on disposal we have realised a loss, and therefore that will be recognised in our statement of profit and loss as an expense. However, if the balancing figure in the disposal account is a debit entry, then that will indicate that during the period we've made a profit on this disposal, and that profit will also be recognised on the statement of profit or loss, but this time it will be recognised as a sundry income, recognised just below gross profit, so in amongst your commission received, your rent received, a sundry income on the statement of profit or loss. Let's take a moment now to stop and reflect back on the activity we've just processed. We were told that the cost of our non-current asset was £18,000. We knew that accumulated depreciation, the loss in value year to date, was £12,200, and that enabled us to calculate a net book value of £5,800. And we were told that the proceeds were 4.5. And we've done the maths, so we know that unfortunately it was indeed a loss on disposal. But what we want to do now is take that information and apply it to the 3 steps. We want to do double entry. So we're going to take the information the question gave us, the 18,000, the cost, the depreciation at 12,200 and the proceeds at 4,500. We've got the numbers for those 3 steps. All we need to do is the double entry. Step 1 is to remove the asset from the asset account, and we do so by debiting the disposal and crediting machinery. Step 2, we know the value, it was given to us in the question, it's 12,200, and we've debited accumulated depreciation and we've credited the disposal account. And the final step is just to record those proceeds. We know that it's 4,500, that information was available to us in the question, we debit the bank and we credit the disposal account. So we've just seen what the double entry looks like. We followed our 3 steps. Now let's look at the impact of that double entry on the disposal account itself. We're going to do exactly the same. We're going to follow the 3 steps. We're going to remove the asset by crediting the non-current asset and debiting the disposal account. We're going to remove the accumulated depreciation by debiting accumulated depreciation and crediting disposal. That enables us, just visually there guys, we can see what the net book value of that asset is by just a comparison of the 2 figures, just like we've done previously. The proceeds is step 3, and that's 4,500. We'll debit the bank and we will credit the disposal account. And like any ledger account at the period end, this account must balance. This account is always shown in the statement of profit or loss, and it will either be shown as a sundry income if a profit has been realised, or an expense if a loss has. We know it's a loss because we've already calculated that figure. But the question I have for you is, will that loss, will that balancing figure be shown as a debit or credit in the disposal account? Will that balancing figure, will that loss be shown as a debit or a credit in the disposal account? So I'll just pause for a moment guys and let you collect your thoughts, and I look forward to seeing what you think. Excellent, well done, thank you. So as you've quite rightly told me, it is a credit, and that £1,300 transferred through to the statement of profit and loss and will be recognised as an expense on my statement of profit and loss. It will be recognised within my expense section, so it will be recognised alongside rent, rates, insurance. It will increase my expenses for the period and ultimately reduce the profit of the business for that period. Disposal account is created to facilitate this transaction. It enables us to remove all the entries for that disposed asset from the accounting records of the business, work out whether a profit and loss has been realised, and then transfer it through to the financial statement, as we can see here. It is completely normal to have either a profit or loss on disposal, and the reason for that is because as we progress through our accounting period, as our assets age, we depreciate them. But our depreciation is only an estimate of how we think the asset will perform. And as we know from our personal experience, some assets outperform our expectations, other assets perhaps don't do as well as we'd have hoped. So the reason for a profit or loss on disposal is because we haven't quite got our depreciation bang on. And that will be quite a difficult task to do so. So a profit on disposal is as a result of over depreciation on the non-current asset. We've been too aggressive with that depreciation during the life of the asset. And what this means is that when we've disposed of the asset, the proceeds that were realised were actually greater than the net book value. Any profit on disposal will be recognised on our statement of profit and loss as a sundry income. The flip of that is we could get a loss on disposal, and we've seen that with our activity today. And the reason for that is because we have under depreciated our asset during the accounting period. And this means that upon sale, the proceeds were actually less than the net book value. So we hadn't been quite as aggressive with our depreciation as perhaps we needed to be. When we get a loss on disposal, as we've previously seen today, that will be recognised on our SPL as an expense to the business. But let's look at another activity now, quite similar to the one before, and let's try and apply those 3 steps and those strategies we've learnt so far to this activity. Bradley Enterprises is now registered for VAT, and they wish to sell some of their old fixtures and fittings. The relevant account balances are provided below. So we've got a balance brought down on our asset account and a balance brought down on the accumulated depreciation for fixtures and fittings. We're told that the fixtures and fittings were sold and that proceeds of £2,000 were received plus VAT. So in total, an amount of £2,400 was received. We need to be very careful whenever we include VAT as to how the question is phrased. Does that figure include it? Is it plus VAT? We're told that the original cost of the disposed items were £8,000 and that those items had accumulated depreciation which amounted to £4,800. Now in this question, we've got £8,000 worth of assets that are disposed, and that £8,000 is already included in that balance brought down of £24,500 on the fixtures and fittings account. Just like that accumulated depreciation of £4,800 is already included in the balance brought down on the accumulated depreciation account. So all we need to do is to take the 3 steps that we've talked about today, apply them, we've got the figures, apply them to the ledger accounts, and we will be able to work out whether a profit or loss has been realised upon the sale. You don't get very far in accountancy without coming across a ledger account, and that's exactly what we're going to do now. We've reminded ourselves of the question, of the disposal proceeds, and we've also reminded ourselves of the original cost of the item and the accumulated depreciation up on those fixtures and fittings. We're given respective ledger accounts, we've given opening balances, I know 24,500 and the 14,700 is familiar to us. We saw that on the previous slide. We've also been given a bank, a VAT and a disposal account. And I make this sound so simple, but all we have to do, guys, is just apply those 3 steps. Remove the asset, remove the accumulated depreciation and deal with the proceeds. So let's just do that. Remove the asset by crediting the fixtures and fittings and debiting the disposal account. We will remove the accumulated depreciation, as in step 2, by debiting accumulated depreciation and crediting the disposal account. And the narrative we use in these ledger accounts is always the name of the opposite entry. So if we look at the credit entry, the narrative will be that where the debit entry is sat. Step 1 and step 2 have been completed. Step 3 is to deal with the proceeds. So we need to debit the bank with the full amount, the £2,000 plus the VAT. 2,400 will be received as a debit into the business bank account. We will then credit the VAT with 400, because remember that 400 is not ours, it's payable to HMRC, and we'll recognise it on the credit side of the VAT account to record the liability the business has. And we will credit the disposal account with £2,000 for the bank, and that will record the proceeds. Once we've done our accounting entries, all we need to do then is to balance and clear these accounts in the appropriate way, ready for the year end. We will do that to the fixtures and fittings account by showing a balance carried down of 16,500. In our accumulated depreciation account, we're going to have a balance carried down on the debit side of 9,900. Our disposal account needs to be balanced off, and the balancing figure will indicate whether a profit or loss has been realised upon disposal. In this example, it is a loss on disposal, unfortunately. We thought the asset was worth more than we actually got for it in proceeds. And that £1,200 will be transferred to my statement of profit and loss as an expense. And I will finalise my ledger accounts by balancing off the bank account and balancing off the VAT account in the normal way. 3 steps. Remove the asset, remove the accumulated depreciation, record the proceeds. And it may sound a bit of a cliche, but practice really does make perfect with these type of questions. Up until now, we focused our efforts on what happens when we dispose of a non-current asset. But what happens when a business decides to part exchange an asset? We need to be comfortable with being able to record this in our accounting records. And of course there are similarities between the two, but there are distinct differences. And the primary one is that we don't physically receive any funds upon the part exchange of the asset. No funds are actually received. And therefore, when we come to step 3, we need to be extremely careful, because there'll be no bank involved in that double entry, because no cash has been received by the business. Instead, what a business does receive is an allowance against the value of a new asset. And this is quite popular when perhaps purchasing a car, and that may even be something that you've experienced yourself from a personal point of view. Sometimes businesses will even consider part exchanging machinery, and that very much depends on the life expectancy of their assets and also the industry in which they operate within. We have seen what the double entry is, what the steps are for a disposal. And just like a disposal, when we account for a part exchange, we need to ensure that we're accurately reflecting those balances within our business ledger accounts. There are similarities between the two processes, but the fundamental difference, and this is something we need to be mindful of, is that there is no monetary exchange of funds when it comes to the actual sale of the asset. We don't get a physical proceed amount. What we do get is a part exchange amount, a trading allowance off the value of the new asset. Perhaps by now you kind of have got the feeling that I like steps, and I do. So I'm now going to introduce you to those steps relevant to a part exchange. The first two entries, they remain the same. We will remove the asset, we will remove the accumulated depreciation. But the third step is subtly different because there is no bank involved, as there's no monetary exchange of funds. So when we record the part exchange allowance, instead of debiting the bank, we now actually debit the value of the part exchange into the non-current asset account itself. And we still credit the disposal account with that amount. Of course, because this is part exchange, there would be a final entry that's required, and that would be to pay the balance of the asset, having taken into account the part exchange amount. Let's take a moment to have a look at those steps that are involved with a part exchange. We know that there were 3 steps for disposal. For part exchange, there becomes 4. Steps 1 and steps 2 remain unchanged. They're exactly the same as what we've previously reviewed today. So nothing new for us to deal with there. We remove the asset, we remove the accumulated depreciation. But as we've discussed, step 3 has to be subtly different because of that part exchange element. There is no bank involved in this transaction because there is no monetary exchange of funds. Instead, what we do is we debit the part exchange allowance through a non-current asset account. And then step 4 is to record the balance of the payment for the new asset. And we do that by debiting the asset and crediting a bank or loan account, obviously depending on how the asset has been financed. We talked earlier about the fact that nerves sometimes can get the better of us in exams, and we talked about the disposal account featuring in the double entry of transactions. And again, if you look at steps 1 to 3, the disposal account represents 50% of that double entry, the debit or the credit. So again, as long as we understand the steps, we should take comfort in the fact that the double entry will naturally just then flow. So now let's look at that final activity, and let's bring together the 4 steps that we've just viewed upon the previous slide. Bradley Enterprises wishes to part exchange one of their old factory machines. The relevant account balances were given below. So we've got opening balances on both the machinery at cost account of 48,000, and we've got accumulated depreciation of 28,000. Within those balances, we've got values of multiple assets. We're told that there is a new machine and that will cost £18,000. So that's the value of the new machine to be acquired. Bradley Enterprises has negotiated a trading allowance of £4,500 for the old machine. So instantly, because of those 2 figures, I can now ascertain that the figure for step 4 will be the difference between the value of the machine at 18,000 and the part exchange, the trading allowance of 4,500. So the physical payment from the bank for this new asset, guys, will be the difference of 13,500. I'm also told that the original cost of the machine was £12,000, and that is already included in that balance brought down of 48,000. And the accumulated depreciation of 11,200, again already included in the balance brought down of 28,000. There is no VAT concerned with this question, so all we have to do is apply the 4 steps that we've experienced previously. Steps 1 and step 2 are quite familiar to us because these are identical to those that we processed when we dealt with disposal. Step 3, we just need to be mindful it's subtly different because there's no bank involved in step 3 because it is a trading allowance, and therefore the debit goes through the asset account, not the bank. And then step 4, just like any normal transaction when a payment is made, is a credit through the bank and a debit through the asset account. So all we've got to do And I know that I make this sound easy, but it really is, if we understand those 4 steps and we're comfortable with them, is just go through the motions with the numbers on our screens and apply the double entry for part exchange. So now let's see those 4 steps in action. We'll remind ourselves of the question. We've got our information concerning our new machine and our trading allowance. We've also got information concerning the original value of the machine and the accumulated depreciation associated with that. We have our ledger account balances. So we have our machinery, our accumulated depreciation account. That disposal account is there again because remember, it facilitates the disposal, the part exchange of a non-current asset. And of course we'll have the bank because we have to pay the balance from there. This time round there is no mention of that, so we don't have to do anything particular with that in this question. We just have to follow the 4 steps, and that is to remove the original cost of the old asset, and we do that by crediting the machinery and debiting disposals. I touched on this earlier, but just as a reminder, the narrative we use will always be the name of the opposite entry. So for example, in the disposal account, I've placed the narrative of machinery because that is where the credit entry is recognised. Step 2 is to remove the accumulated depreciation. Debit the accumulated and credit disposal. Step 3, remember there is no exchange of funds here. That 4,500 I'm not physically getting, I'm just getting an allowance of the value of my new asset. So I'm going to debit the machinery account and credit disposal. And the 4th and final step is to pay the balance from the bank in this question, and therefore I'll do that by crediting the bank and debiting the asset account. And like we always do, guys, whenever we have ledger accounts, we must make sure they're finalised for the period end. Those accounts, as you know, on the statement of financial position will have a balance carried down. Those accounts on the statement of profit or loss, will always be transferred through to that financial statement. There is a balance carried down of 54,000 on the machinery account at the period end. The accumulated depreciation has a balance carried down of 16,800. My disposal account will either show a profit or loss on disposal, depending on how that balancing figure works. I could work it out because all I need to do is compare the net book value of the asset at the point of disposal with the part exchange allowance. And that's something I'd like you to do for me. So guys, just a moment, just to pause and have some time to reflect. Can you work me out whether it's a profit, whether it's a loss on disposal? And if you're feeling really brave, if you could tell me what the figure is. So is it a profit or is it a loss? And I'll just leave you for a moment. Perfect. Thank you for your contribution. It certainly is a profit. And that's quite unique for this presentation because so far we've been inundated with losses. But what this means is at the point that the asset was disposed of, we thought the asset was worth less than actually the part exchange allowance. So our proceeds or our part exchange allowance in this question was greater than the net book value of the disposed asset. So we have a profit. That profit is recognised on the debit side of the disposal account, as you can see, and will ultimately get transferred through to the statement of profit and loss as a sundry income. And finally, to conclude, the balance carried down on the bank is 61,500. Steps really do work because they give you some form of structure to follow. If we follow our steps, we're not going to miss a step out, we're not going to miss a particular process. As a final check, when you have completed a part exchange activity, there should be 2 entries on the debit side of your machinery account that agree to the value of your new asset. And in this example, the value of my new asset is 18,000. I've got 2 entries that equate to that amount. So I'm relatively confident that I've done all my transactions correctly. And that concludes the Thank you so much for your participation and also for listening. I sincerely hope you found it useful.